Right, good afternoon, everybody, and welcome to Essentials. My name is Dale Franklin, and it's my pleasure to host you again. Thank you for joining us on shorter notice. This is an unusual time for Essentials. It's normally closer towards the end of the month. But seeing that the topic was so needed, we decided to run it sooner than later. One of the things that when we thought about this topic early on, we were talking about the end of COVID and the end or potential end of Ukraine. And it's funny how 2 or 3 weeks later, how much more there is to talk about and how much rain has fallen since over the last 3 weeks. I think that often we reflect about how financial planners in this situation are often the unsung heroes when you're at the cold face of clients and you are the person that has to deal with this. One of the things that Peter's going to share with us today is his sight, and hopefully we will see clearly when the rains have gone. Peter Armitage is no stranger to the forum. He's the group CEO of Anchor and been in the market for many, many years. Pete will be sharing some of the insights and hopefully some of the opportunities that may be unearthed from the terrible market drops that we've seen. If I could ask you all, please to put your questions in the question function on Zoom, and we'll address as many as we can towards the end. And everybody, please to try stay for the full hour to ensure that we can get you the full CPD point. And let me hand over to you, Pete.
Hi, folks. This is a time of intense communication with all of our clients and internal and external. I think when you live in the market, you understand that you go through market dips. On average, these kind of dips at least every 3 years. So for those who've been around a long time, you know what's there. I think the key thing that we're doing at the moment and what we think people should be doing is just going back and revisiting the thesis on shares, on investments. And the key intention of today really is to give some context and perspective in terms of where we sit and where we think the opportunities are or are emerging. So I think the key point is global markets are getting cheap. Depending on your measure, they've fallen between 20 and 30% from their highs. Importantly, over the last year, we've had about 20% earnings growth out of global markets. So 20% earnings growth and 20% market dip, the shares are about 40% cheaper. So at stages like this, people always want to know when's the bottom. We're never going to time that exactly, but we'll give you some perspectives as to how we see that. We think we haven't really seen the bottom from an index perspective, but certainly for some shares, we think they've reached levels that we'd be happy to buy them with more than a 3-month outlook. What happens in the next 3 months, the only thing I can guarantee you is volatility. The market's still absorbing which companies can make money out of this. If you saw last night, we had Walmart coming through, missing earnings. That was considered one of the defensive shares. Share price down 11% today. And the market's still learning. Quality businesses are ones that have got pricing power and can see their way through cost increases. Really that quality threshold will increasingly be tested over the course of the next year. We think that about 10% down from here, or in 6 months' time, if the market stays at the same levels, that we can bang the table with a huge amount of confidence in terms of 12-month returns, and I'll take you through what we mean by that. So we still think some patience is required for investors who can stomach anything over the next 3 months. We'd be happy to invest money back into markets, and great opportunities are starting to surface. Then we also at times like these other opportunities come about because there's a change in volatility, there's higher rates on money and the like. So we've come up with, in more recent terms, in clients' portfolios, we can now earn them 5% in US dollars with offshore portfolios. We certainly, with very low risk, we certainly couldn't do that a few months ago. We've got a structured product option with roughly 20% per annum coupons. And then for those who want to take, we've got a lot of risk appetite. You can buy options fairly cheaply. And, so the change in circumstances is good for some assets. It's bad for other assets, but it also arises in opportunities. I think there's one slide really that I could literally do this whole presentation on, and most of the presentation is going through the basics of that. But in terms of where are the opportunities in the world at the moment, the opportunities on the left, which is pretty cheap, it doesn't mean we'd buy all of them right now. And in the context of a portfolio, we'd be quite selective in terms of how much we would put into each things. But the greed factor in the market, which pushed a lot of kind of more fashionable shares to high valuations, it's now reversed completely. And we've called it greed getting pretty cheap. On the other side, fear is getting pretty expensive. So you sit in a market where the more defensive companies are actually still pretty expensive, and they've held up quite well over the course of the last 6 to 12 months. But there's certain segments of the market where people might feel safe and because they're defensive businesses, but they're pretty expensive, certainly on a relative basis. So to quickly talk through the ones on the left, greed getting pretty cheap. Close to the cheapest quality cash flow streams in the world can be found in Chinese tech shares. Many of those are down 60, 70%. The outlook for those companies has changed a fair bit, but I think any kind of rational valuation would lead you to price targets kind of 50 to 100% above current levels. There are some quite unique regulatory risks in China, and we certainly wouldn't be underweighting those, but for clients who've got some risk appetite, that's certainly where the biggest optionality sits. Big tech US companies, the likes of Meta, Alphabet, and the like, are the cheapest they've been in 10 years. So for the ones where you've got some confidence level in the sustainability of their growth rates, there's some great opportunities there. The premium you pay for growth and quality, as we said over the course of the last few months, first of all, there were kind of two tiers of the market. One was the unprofitable tech companies. We didn't have much exposure to that, where your profits are coming in quite a few years' time, and you're discounting those future profits back to today at a much higher discount rate. So there you've seen companies off, a lot of them off 40, 50, 60%. We don't think a lot of those are still overpriced in our opinion, but there is the real premium growth quality cash flow businesses are cheaper than they've been on a relative basis for the last 10 years, and we'll run through that. We think SA bonds are pretty cheap. The highest yields that you've been able to achieve for kind of 5 or 6 years. And if you can achieve a very low risk 10% in rands, we think that's attractive. US corporate bonds, for the first time in many, many years, the whole sort of 60-40 bond, equity bond portfolio offshore, the thesis over the course of the last 60 years fell apart starting about 7 or 8 years ago. You now can get 4.5% on a high quality US corporate bond. So that's starting to become much more attractive on a risk return basis. The companies of the future are getting pretty cheap. So companies where you're taking some risk, the kind of biotech space, where you are dependent on the future changing. Those are typically pretty risky. You'd buy, if you wanted exposure there, you'd buy 10 of those companies, 2 or 3 might work. But there was a lot of optimism priced into a lot of future growth type companies, where there was no chance that their cumulative value was justified. Those have all come down in many 80 or 90%. So across the spectrum of more growthy type opportunities, there's already some pretty good value. And from an SA perspective, we tried to identify some shares that we think could double. That doesn't mean that they're all big shares in our portfolios, but we're kind of looking at upside optionality. And the likes of Naspers, Massmart, Pick n Pay, EOH, and Afrimat are shares which, if their story materialized as management would like to hope, those are shares that have got the potential to double. On the right-hand side, fear is getting pretty expensive. So people are paying up for things where they feel protected. And along the lines of that, we identify market insurance. So if you want to hedge portfolios and the like, that's pretty expensive. Oil is obviously very expensive. That won't last forever. Oil prices are cyclical. Coal prices are absolutely off the chart. Our biggest success story in our local mandates this year has been Thungela, which listed, I think, just over a year ago. It got unbundled from Anglo American at around 25 Rand. It's now sitting at 280 Rand. And coal companies are making roughly 5 to 10 times what they were making a year ago. Wheat and grain is expensive. Obviously, a few of these things are driven by Ukraine. So, the kind of platinum group metals, oil, coal, wheat and grain are things that have been subjected to what's happened from the Russian-Ukraine crisis. Lithium has gone off the charts. Obviously, it's a big part of the electric future. Tesla is pretty expensive, although that's not really fear. It's still sitting in the greedy type camp, but not everything follows our thesis exactly. Defensive US shares are very expensive. So, just be cautious of global equity funds that the ones that have if a fund has done pretty well over the next 6 months, understand why. If it's been due to oil exposure and playing commodities, that's fine. If it's because it's sitting in defensives and utilities and value shares, you're sitting there with valuations still at very high levels because they haven't come off the same as they haven't come off to the same extent as the growth shares. And then new themes are getting pretty expensive. So there's quite a few trends out there like cybersecurity and the like, where those are still trading at 40 type multiples. So you've got kind of two spectrums, and it's clearly when things collapse, there are things to buy. With a focus on quality, we think you can put together a nice portfolio out of things that have fallen with a lot of upside optionality. What we've battled with quite a lot, for those of you who follow our webinars over the course of the last 9 months, we've been expressing a lot of caution on global equities, still forecasting a positive 12-month return, but the valuations have been concerning us. A lot of shares are now getting back to valuations where, as we said, a little bit more of a drop and one can bang the table. And the circle in the middle, global equities markets are not yet a bargain. As we'll show you, they're sitting at kind of below average levels now, but you'd need that a bit more time for earnings growth to come through to bang the table. But importantly, the word's on average. So we're looking at index levels. Within index levels, there's shares that have gone up and shares that have gone down. And obviously, if markets are down 20%, it means a lot of shares are down 30 and 40. And that's where one can find some nice opportunities. We're still expressing the fact that one should be patient. New money probably get phased into the market. Obviously, at times of huge volatility, you never know exactly where the bottom is, but we'll go through that from a principal point of view. So the market is rolling over. The slide shows the S&P over the last 3 years. We've got to the stage where we're now down over 1 year. The average share, importantly, the point I was making at the beginning. So index levels, we've got the S&P down 16, the NASDAQ index is down 26, 28. So it kind of 15 to 30% drops. But there have been quite a few big counters that have held up pretty well. So if you look at the NASDAQ, the average price decline of a NASDAQ share is 49%. So we've had and already experienced a crash in certain segments of the market, which has obviously been pretty hard to absorb. A key point to remember, if you want to get global returns, the market has always been and remains the best long-term bet. If you go over almost any time period, you kind of get 7 to 12% compound dollar returns. The last 10 years, the average has been about 10%. And markets come off and markets dip, but they always come back because, if you're in quality companies, the earnings grow and you get paid out dividends. So we always recover from circumstances like this, and taking the long-term picture and putting it in context is important because it's very tempting if you go through the big dips, way back that don't look like big dips on this chart. But, the inclination at each of these is to run for the hills, which was always the wrong thing to do. And, the biggest risk is you're giving up timing. So this slide really informs and probably most simply how we're feeling about the market and valuations. So over the course of the last 10 years, the average forward PE multiple in the S&P has been in the region of about 17.4. We've got up to 25 or so. We were quite concerned about valuation for some time. And the recent dip in the market, together with earnings growth that's come through over the last year, has got us to about a 17 forward multiple. So that's a little bit below average, but it's not yet a bargain. When is it a bargain? Well, over the course of the last 10 years, one standard deviation away, which is 15 times, you can see at any time in the last 10 years, when it reached that level, it was a pretty good buying opportunity. So that, and another key theme that I want to convey in this presentation is market valuations are to do with two things: market levels and time. So first of all, if the market was to dip 10% from here, we think you then get to a level where you can buy with quite a lot of confidence. In other words, we think that the worst case is then close to priced into the market. Doesn't mean you can't still have big volatility along the way, but if you took a reasonable time period. Or time. So market dip, if earnings over the next 6 months are going to grow, we think probably by around 10%, then the market also gets down to that 15 forward multiple. So that's from an index level. And then the key point is, as we were saying, underneath that, there's shares that are already sitting down well below long-term values, and we'll run through some charts. Earnings growth, the company is coming through very strong earnings growth in America. Still, the consumer is very strong, which is why our base case is not a recession. We think the economy will slow down a fair bit. But we think reasonable earnings growth again in 2023. That might seem overly optimistic and might well be downgraded a bit. But I think one of the key issues is that a lot of companies are underperforming this year, despite the aggregate growth being quite big, because they can't meet demand because of supply chain issues. So I think of a company like Nike, their earnings will be flat this year, but we think up about 20-25% next year because the supply chain issues will be much better and they can produce more product. So the earnings growth numbers are still quite supportive. So to go a bit deeper, the dilemma investors faced as 2022 began. COVID measures being withdrawn, inflation was starting to get high, before Ukraine, equity market valuations are elevated, but world economic growth seemed to justify, a reasonable, if muted, return from markets. Then we obviously had Russia invading Ukraine and China doubling down on its zero COVID policies. The Chinese one we're less worried about. I think that gets out of the system quite quickly. But I think we're almost going to have to learn to live in a world that's very different from a geopolitical perspective. We think global inflation is starting to peak at very high levels. You must remember inflation is comparing things against 12 months ago. So once you've had 12 months of high inflation, just the maths of it means that it comes down a bit. And the key really is, where does inflation settle once we've been through the shocks that we've been through? This is a Goldman Sachs chart from a few days ago. They're saying that core inflation is currently sitting at about 3.5%. So this is excluding oil and food, which is obviously relevant, but not part of, what you're really concerned about is a wage psyche of 3 to 4% wage increases getting into the inflation base, as opposed to the kind of existing 2. And Goldman Sachs are actually on the kind of more bullish end, saying that they expect by the end of this year, core inflation to get down to around 3%. And everybody's just kind of assuming that there's a 50 basis point hike a few times in the US. And if core inflation comes down a bit or the economy slows dramatically, there might be a decision much more of a discussion about 25 or 50 basis points. So the market is currently assuming the worst. It's assuming high interest rates. It's assuming that oil prices stay high forever, and that bond yields stay high. And there certainly is room for along the path of uncertainty and volatility, there's room for kind of a bear market snapback, as things might not be as bad as what people are expecting. I think there's a lot of pessimism out there. So one of the key things we wanted to get across is we want to have a quality share portfolio over time, and they certainly do prevail under high inflation. In other words, if your costs are going up, but you can pass that on, it can in fact be pretty good for certain companies. And what we want to do over time is buy quality shares at reasonable prices. That's been fairly challenging to put new money into finding that equation over the course of the last year. But this market, the market meltdown we've had, is giving us those opportunities once again. Quite consistently, quality shares have almost always done better than the S&P return. The Chinese lockdown is quite severe. So the dark blue line is 2020. So that was the real COVID. This is subway passenger turnover in China. So it got down to almost naught in 2020. And the previous lockdowns, you can see the impact coming through. And the latest one, which is 2022, which is the purple line, you can see things went down quite significantly. And we're still sitting at kind of half of normal levels from a subway passenger turnover number. And this has exacerbated supply chain issues around the world, because China simply hasn't been able to deliver what, to meet the demands of the world. We think the supply chain, this is kind of a global supply chain index, and you can see that has started to top out. That means conditions in supply chain are still pretty poor. Many companies around the world just can't access the stock that to meet the demands of their clients. But it has looked to top out. And if interest rates go up a bit and things cool down a bit, China normalizes, which they're talking about now in countries like Shanghai, and this does get better. So there's a lot of factors all conspiring to push up inflation and put a lot of pressure on things. We think most of those things have started to top out. And really the key question in investment then is what's priced into the market. And we're saying that in many shares, it's still got to get priced in, but there's many shares where quite a bad case is factored in. The market doesn't usually respond that badly to kind of previous conflicts. If you look at the 1-year return and maximum drawdowns from the conflicts over the course of the last 40 years, they tend to be quite focused on one territory. So there haven't really been massive calamities. And in fact, since the Russian invasion of Ukraine, the market's been over 3 months down 3.7. It's got a bit worse now. But I think the impact of that is being felt. We're starting to see a more significant impact. And we're now down, as we showed you, depending on what market, down between 15 and 30% for the year. And that's the point that we're making, is that's quite extreme already. Global economic growth, which is the backdrop, we think will remain reasonable. That 3.5% in 2021 was sitting at 4.2 a few months ago. These are the IMF numbers. But 2023, we think world growth will still be reasonable. You might go into technical recession for a very short time period. But remember, you're going to have a lot of recovery next year from things that are still locked down and stuck this year. And China, on a 2023 versus 2022 basis, we think will be quite strong. So, there's reason to go. It isn't all fall down. Things will come under pressure. The key issue is the US consumer is in a great space, which makes the Fed more kind of resolute about trying to pull it back a bit. And the risk is they pull it back too much. I think importantly, kind of bond yields tell a big story. And you must appreciate the difference between bonds and equities is bonds is simply an interest rate. So the risk is always the same with the US government. They can always pay you back because they can print money. So it tends to price in things pretty quickly. So the upward kick up, it's the 2013 temper tantrum, the Trump election, and the pandemic inflation shock. Literally within the matter of a few weeks, you get things priced to roughly where they should be. So this is now at about 3%. The US 10-year bond yield, you can see if you look out over the last 15 years, that's quite a high level. So it's already priced in a lot. The equity market takes a fair bit longer to price things in. And that's because not everything, rates going up and inflation going up isn't negative for everybody. There's some companies that gain, there's some companies that lose. And the market kind of takes a while to figure out who can handle it, who can benefit from it, and who will suffer from it. But I think the point that we're making, certainly in the bond market, we think that quite a lot is priced in. Most forecasts for longer term inflation, a few years out, are back to kind of two to late twos inflation, in which case, you want a real return on that, which gives you a bond yield of around 3%. So if anything, there's potential for, to kind of have a bit, some positive capital gains on bonds from here. There's a few slides that, in the interest of time, I'm not going to talk through. You're welcome to, we'll be sending out this presentation for people to absorb. But, our thesis and where we sit over time is high return on capital employed, compounding businesses. And, the returns on those are significantly higher than defensive businesses over time. There's been a massive rotation from growth, quality and growth into value shares. So you can see, the shares that have had the big drawdowns, IT services, media, software. That's where you've had your kind of 40% drawdowns, mostly growth shares, and much less of a pullback from kind of your more defensive value type shares. So this only lasts for so long. And once the market feels that it's priced in, you'll start to see it move the other way. So, our watch list of companies that we really like, this isn't necessarily our portfolio. Year-to-date performance, a lot worse than the S&P, which kind of goes without saying. That segment of companies has done worse. But I think very importantly, sorry, that's not 1 year performance, it's 5-year performance. You're sitting at double the return over time from these businesses. And, we'd simply, at the same valuation, we'd just very simply rather be in a company growing at 15% than one growing at 5%. You're almost guaranteed a higher return over time. Our portfolio, EPS growth between 2016 and 21 was 25% against an S&P of 12. And from last year to 2024, about 19% compound earnings growth versus 12. And this is where time is on your side. If you can get earnings growth of 15 to 20% coming through, market stays at the same levels, you reprice quite quickly. And, that's why the market always comes back. The next point we made at the beginning was that a quality, let me rather show you this slide. The premium that you've had to pay for growth, which is reflected in this blue line, the forward PE multiple of higher growth companies are obviously always going to be higher than the PE as the market as a whole. But the value of the growth shares on a relative basis has got a lot cheaper. So you can see over the kind of COVID years, for a few years, you had to really pay up to be in growth companies. And with our philosophy of being, wanting to invest in quality companies at reasonable prices, it was quite challenging to populate a portfolio with things that all fitted squarely into that. We're now sitting where historically extremely cheap levels, so really good businesses with nice growth rates are the cheapest they've been relative to the defensive shares and the value shares. And there's obviously two components to that. The defensive shares are now pretty expensive, and also the other ones are pretty cheap. So you've got to look at things obviously on an absolute and a relative basis. So what are we doing right now? We think there's going to be volatility. We could still have a further leg down in markets, but there's certain shares that we can buy. So to have the right cash positions for clients, we're identifying the new opportunities. We focus on, it's always going to look 12 months ahead. And we think within 12 months' time, you'll be coming out of a lot of the pressures that we're facing. We're not seeing a long downward cycle. And as you come out of that, you want to be owning quality companies at a good price. And this has been the best opportunity, I think, in 4 years to play that game. Structured products and hedging as insurance. As we said to you at the beginning, we don't play a hell of a lot in structured products, but they're particularly attractive at the moment. And we can get 20% coupons with acceptable risk, shall we say, which we're starting to put into client portfolios. You've then had, it's all of these macro talks are all about indexes and markets as a whole. There's also individual companies. So one of the biggest disasters over the course of the last year has been Netflix, which was the absolute darling of the market for many, many years. And the price for disappointing the market over the course of the last 6 months has been extreme. So if your earnings, especially for the more expensive companies, if your earnings didn't meet expectations or your forecast is more muted, many shares are coming off 10, 20, 30%. Netflix was growing its subscriber base at 15 to 20 million a year for years and years. 2020, it grew that by 36 million because of COVID. And it's given back some of that. So you've had a quarter now of basically flat growth, and the market is pricing in the very worst. It's saying this company is now basically X growth and not going to achieve further penetration and the like. So, it will be 6 months before the answer to that is found. But we like having, even if they're in small proportions, these kind of stories, a collection of these. We've got great businesses To my mind, the 199 Rand I pay for Netflix in South Africa is enormous value relative to other entertainment options. And streaming has only got about 20% US market share in terms of TV time. So we think it's still a secular growth story. It's given up some of those COVID gains. So, that's why you haven't seen it kick up. At the same time, probably 5 or 10% of their customer base, Disney Plus came along, and much more Disney Plus customers. So that certainly, it hasn't stopped growth, but it's taken away that kind of extra growth. So we're constantly assessing where these opportunities are. By contrast, a company like Apple, which has held up incredibly well. If I was to bet on kind of an S&P 100 reliability of earnings growth, Apple would be right up there. You can see their total devices. So Apple's come off a little bit, but it's, this is the kind of, we've quite enjoyed the additional pullback over the course of the last week or two. And for people who weren't invested in, provides an opportunity. We then talked about the Chinese tech shares, which have been a complete bloodbath and almost heresy. But it's important when you have had complete capitulation here, people just bailing, don't talk to me about it again, which is always a good time just to look at the facts. And here you can see the Goldman Sachs a few days ago came out with a report where they've got, kind of in the top shares, on average 77% upside to target prices. And that's just looking at, so the whole group has got a forward P multiple of about 15, and that includes your very expensive shares. But you can see up at the top, the Alibabas and many others sitting at 9, 10 P multiples. For businesses, which in many cases are still fantastic growth stories with massive cash flows and great profitability. So JD.com, which is China's third biggest online retailer, came out with numbers yesterday, and their turnover was still up 18%. So that was ahead of market expectations. It led to quite a big rise. These are big companies. JD.com, just looking at the numbers yesterday, 220,000 employees, 1,400 warehouses around China, tens of billions of dollars of revenue. So a small portion. You want to, in your portfolio, you want to have some of the stuff that's got really nice upside optionality. Last year, all of the tech stuff came under big pressure because of regulation. And we think they've largely completed what they set out to achieve. And for the first time in 6 or 7 months over the course of the last month or two, the government is coming out with market-friendly statements and support for the companies staying listed in the US and the like. So, here they've got JD.com with 93% upside, Alibaba with 73%. So in terms of looking at, when the rain clears and you can see clearly, you want to be in some of the things that probably have suffered too much from the kind of conditions that we've seen. I've then just done some very simple price and PE multiple graphs. So the purple line in all of these charts is the PE multiple, and the black line is the share price. So if you look at the black line for Walt Disney, it's basically the same price as it was 7 years ago, and getting down to multiples way long before it kind of became more of a technology-orientated company. Walt Disney is a lot more defensive than many of the tech businesses because it's got real-world businesses in terms of movies, theme parks, etc. So we think and it's now got 150 million internet subscribers, which, as you can see, only a year ago was being valued at a huge premium. So you're starting to get, a lot of these good quality, best global franchises in the world trading at their cheapest levels in 5 years, low forward multiples. So, if you forget about all the index stuff and we think it can still come off 10%, I'd be very happy to buy Disney right now at this price from a 12-month, 24-month perspective, and we think you'll get a pretty good return. Facebook, and Disney, there's no real kind of big issues or question marks like a Netflix, and there are obviously question marks in a company like Facebook Meta, where people are questioning whether usage is shifting away from Facebook and Instagram. The last numbers tend to indicate that it's still holding up pretty well. And they've started investing billions of dollars every year in the metaverse, which is still to be clearly defined. We'll only know in 5 or 10 years' time exactly what that means. But importantly, in the last earnings statement, Mark Zuckerberg made it clear that they still had a growth imperative and they'd only be using growth in the business to invest in the metaverse. The big scare, when it took a big pummeling, if you look through to a few months ago, is that the company's earnings would now be severely dented by the investment in the future and with the outlook being far less certain. So what you've got is a company whose forward multiple is now around 12. So we think that the Facebook share price is factoring in a very, very poor outcome. And a share price, which is now, again, back to levels of about 5 or 6 years ago. We then look at a company like Google, Alphabet, done incredibly well. This is a core holding, I think, for any portfolio. They've got a real powerful entrenched position, hugely cash flow generative, makes a 30% margin. It's got 15% of its market cap in cash, buys back 3-4% of its shares every year, and lots of growth vectors still to come through. Now, I want to contrast this with a Coca-Cola. So I'm fairly, the market consensus, the analyst numbers out there have got Google still being able to grow at 15% for quite a few years to come. But it's trading at a 17 forward multiple, which, as you can see, the average over the course of the last 5 or 6 years has been in the kind of 20 to 22 range. And in the over-exuberance and greed, that got up to kind of a 30 forward multiple. So Google trading the cheapest in 5 years. But in the next slide, something like Coca-Cola, which we think can only grow by about 5 or 6% per annum going forward, obviously hugely penetrated around the world. And that's the most expensive it's been for 25 years. So just because the market's taking the pasting, it doesn't mean that you buy or sell the whole market. So we think the relative price performance of a Google or listed as Alphabet relative to a Coca-Cola will be almost the opposite of what it's been over the course of the last few months. Then, so that's kind of global markets and some perspectives on them. It's very difficult when you've had a dip. Nobody wants to kind of firmly state any views. So to be clear, and at the risk of repeating ourselves, we still think the market could potentially come off 5 or 10%. If it did, that would be a great buying opportunity. But you can't always rely on being able to find the very bottom of things. And there certainly are some shares that would be prepared to invest in with a 12-month projected return. Then we move over into the domestic space where domestic bonds are cheap. This is the R230 bond yield. And you can see that's now at about 10.3, 10.4%. So long-term over that 10-year period, inflation in South Africa is probably going to be around the 5 to 6% level. Obviously, you're seeing a spike at the moment. So a 4 to 5% real return for the least risky asset in terms of getting your capital paid back is about as attractive as it's been for the course of the last 5 or 6 years. So, if you can sit and just earn close to 1% per month and not be too worried about volatility, we think domestic bonds are very cheap. From an equity perspective, we thought maybe the best way to look at things is just to put our top 10 local equity holdings. We've got Thungela right at the top, which looks it's very strange for us in terms of our style, but that's been literally as a result of performance. So that's gone up about 5 or 6 times in our portfolio. We've constantly been trimming it, but the story for coal is just so compelling. Normally the coal price a year ago, people would have projected a coal price at over $120 and it's trading at $300. So Thungela is absolutely creaming it, making share price of 280, it's making around 15 Rand per share per month at the moment. Then Naspers and Process, these things are trading at 50 to 65% discounts to their value. I think everybody's kind of got tired of any talk about corporate action or value release. We think the company remains under massive pressure to unlock the inherent value, and you will see some further moves at a point in time. We spent quite some time talking to them yesterday about the tax implications of different actions. But importantly, one statement from Naspers or Process about value unlock done in a way that the market supported. You could literally see the prices up 100% in a day. And it sounds like an absurd statement, but if something's worth 100 rand, it's trading at 35 rand. If there's a case of value unlock, any kind of unbundling, 10 cent buying to Naspers, the 35 could double to 70, and that's still a 30% discount. So in the SA context, you simply just have to hold them in the portfolio, because if and when that takes place, we don't have a short-term expectation. You'll be absolutely murdered if you don't hold them. Bidcorp, we think, is a nice option. Well, maybe just to finish on commodities, so Thungela, Glencore, we also own South 32, those companies, coal, which we think has still got some quite a long time in terms of high prices. Afrimat, which is really a bottom-up company story, and Impala. So, in fact, quite a few commodity shares have found our way into the top 10 shares. We kind of almost always uncomfortable holders of commodity shares. They don't fit into our core thesis of compounding high return growth, but that's been where the opportunities have been. And then, just to make the point, we said the 5 shares which had the optionality to be able to double. We identified as Naspers, Dash Process, Massmart, where I think everybody doesn't believe in any kind of turnaround. If management achieves what they think they can achieve, they could earn 7 rand, 8 rand a share in 2023, and the share price is sitting at 40 rand. If they achieve that, and some analysts are forecasting kind of an 80 rand share price if you look out a year or so. Afrimat, in terms of the new volumes that it's bringing on board and its new projects, it can double the size of its business, and one or two others, which we'll remind you of at the end. So obviously, a presentation like this, we're not going to get into too much detail on products, but you can basically achieve about a 17 to 20% coupon with kind of quantifiable risk, and we think acceptable risk, which we think is a great opportunity at a time like this. We can also do structured products which capital protect your portfolio in return for taking a little bit of the return away for people who are still concerned about downside. Then there's options out there, and this is very non-vanilla. It would only be for a really high net worth client with some appetite for risk. But you can make 7 times your money if you think that Netflix can get back to $400 over the course of the next few years. This is just, it's more an indication of what's available out there than something that we would suggest actively getting your clients involved in. And then, finally, suddenly you can earn some yield out there with the 10-year yield going up. So it's something that we think from a risk return point of view in dollars looks particularly attractive is the offshore bonds of South African companies, where we're very comfortable with their balance sheets. And there we can achieve about a 5.7% dollar return. And so for people who, if you went to many investors and said, I'll give you a 6% dollar return for the next few years, they'd be delighted with that. So that's actually achievable now. So that's kind of tying up where we think the opportunities are in the world. Some of them are not opportunities immediately, because things are down 30, they can still go down a fair bit before they bottom. But we think a rational approach is to look 12 months out to say a lot of the issues that are out there will have passed, or we will have got through them, and you want to emerge from there owning the things that providing the opportunity at the moment. So the greed stuff is getting pretty cheap. Chinese tech, big tech US companies, the premium that you have to pay for growth and quality, SA bonds, US corporate bonds, companies of the future, and then the potential doublers, Naspers, Massmart, Pick n Pay, EOH, and Afrimat. And then the stuff that feels good is actually pretty expensive now. The stuff that makes you feel comfortable, market insurance, oil, coal, wheat, grain, lithium, Tesla's, as I said, slightly different category. But specifically the defensive value US equities are not value anymore. And as we showed you, something like a Coca-Cola, record high multiples against record low multiples for companies that are growing a lot faster. So that in a well-timed 45 minutes, folks, is kind of our views of the world out there. And we'd welcome any questions to finish off the discussion.
Well, thank you, Pete. And can I say that it's a master presenter when you say speak for 45 minutes, speaks for exactly 45 minutes. So well done. If everyone could please type their questions into the Q&A, and we'll try to get through as many as we can. Peter, first question. Markets are cheaper, as you mentioned, but are we not going to see companies revising their growth forecasts lower?
Yeah, I think you'll definitely see that in aggregate. So I think, in some cases it's priced in some cases it isn't. I think what you've seen in the first quarter results coming out, earnings growth has once again been pretty strong, but companies have already been quite a bit more muted in terms of their forecast numbers. So I think there's two elements to look at. One is, and what we've been emphasizing in terms of quality companies. So with high inflation and the dynamics out there, the conditions aren't bad for everybody. Companies with this high inflation and you can pass it on, you can actually make quite a bit more money. So something like a Cisco, a Bidcorp in terms of food services, they take a small margin, they're not going to give up on their margin. So if food inflation is 6%, you're adding that to the turnover level. So your quality companies, you want to be in companies where you've got much less of that risk. I think that, so what we call secular growth companies. So Microsoft's Office product and Microsoft's cloud computing future is completely unrelated to economic cycles. It's a secular trend that isn't stopping. So as the answer to your question, the overall terms is absolutely. There will be some company, and it's not really companies downgrading their forecasts. I think that's already kind of in the system. People are already saying there's a lot of uncertainty out there. I think the analyst forecasts are going to come through, but it really will be the case of the quality companies shining through, and that's where one's got to focus.
Pete, quite a long, meaty question. It says, I hear you regarding inflation peaking, but am I correct in saying that these increases are in numbers, i.e. future inflation is off at a much higher base, so people are effectively poorer to the extent that inflation has risen by close to double digits? You can argue you have the benefit of higher asset prices too, but I just wanted to check my thinking. Does the Fed keep hiking into a serious recession if inflation stays high, or do they roll over and go soft on rate hikes?
Yeah, so I think there isn't one overriding answer to the inflation question. We spend quite a lot of time looking at the constituents of it. So to the extent that prices have gone up permanently, and then you are poorer, and wages are running, wage increases are running at about 3.5, which is quite similar to the core inflation, which is the important thing. So oil prices in a year's time, we think will be lower. So are you poorer? So inflation might be quite low, ironically, in a year's time. If oil comes, if you're measuring it against oil at $115 and then suddenly oil at 95, it can actually have a negative kicker to inflation. And that's why they look at core as opposed to fuel and the like. So you've got a general price uplift, and then you've got some specifics that have been pushing inflation a lot. So almost 2% of the 8.5% inflation has come from car prices. In the US, used car prices are up 50% year on year. So you compare it to a time period where there wasn't much demand at all, to there being a complete, due to supply chain, a lack of supply of new motor vehicles, and in many instances, complete unavailability. So people, they need a car, and they're prepared to pay more than a new car price for a used car. So that isn't permanently up. In a year's time, when things level out, used cars will go back to being 30% cheaper than new cars. So there's quite big elements and chunks of inflation that haven't pushed prices permanently up. And in fact, the way you measure inflation on a 12-month basis in a year's time can be a big pull down on inflation. So you could see in a year's time core inflation between 2.5 and 3, but actual headline inflation, if supply chain disruptions come back, actually being lower than that rather than higher than that. So there's a lot of moving parts, but I think the key thing to watch in the whole world is that core US inflation number. That's going to be the determinant of where interest rates go, how aggressive the Fed is, and how long this kind of economic downturn from almost unhealthily high levels continues to last.
Peter, I think you've largely addressed this question, but I'm going to ask it anyway. Would Netflix be a good holding? Is it like Sasol in 2020?
Yeah, I mean, I wouldn't say quite like Sasol. Sasol screwed up their business, overgeared. We're facing a rights issue. Netflix is balanced. So Sasol went to irrational levels because there was potential for a massive rights issue to sort out a balance sheet problem. Netflix has no balance sheet issues, and it's not in your unprofitable tech company space, making a 20% margin, generating cash. So the business is quite healthy. The issue really is it now X growth? And you got to take a view on that. And I think the company themselves are a little bit nervous. You can imagine your management of a business where you've just naturally grown by 10 to 20 million subscribers a year, and suddenly you grow by 35, and then you grow by 0. And you go, is that slowdown just, kind of things leveling out and people are going out more, so they use less, but the long-term trend is still there? Or have they reached kind of a certain level of saturation before they thought? And I think they're all scratching their heads and they're all quite nervous. So, but the point that I'm making right across the presentation is what's priced into the shares. I think what's priced into the shares, and in fact would make it reasonably priced, is if this thing isn't going to grow anymore. You reach the saturation. I think they certainly have reached saturation in America, but around the rest of the world, I think there's still another 100 million subscribers for them to add on over the course of the next 5 years. If that's the case, the share in a few years' time will easily be double the current valuation. So that's the call you've got to make. We don't have the absolute crystal ball, but I think, and it comes back to, if you think about the tech companies and how they've done, and any product companies, if you feel that they're offering a competitive, quite unique service at a good price, and there's still some kind of market momentum to come through, that's typically been a reasonable company to own over time. And that's certainly where I'm at from a Netflix perspective. I sit with my DSTV bill of 1,000 Rand and my Netflix bill of 199 Rand, and the relative value I get from the two is amazing. So it's a bet I'd be prepared to place. The bet is obviously a lot less risky with the share price under $200, and it was at $700. So, a lot of these things are, at times like these, one tends to be pretty conservative, and the inclination, as I said, is to be in defensive shares. But if you look 12 months out, certainly, I'd like to have a little bit of my money on that particular bet.
Peter, do you have a view on Omnia? It seems to be going up steadily over the past 2 or 3 months with no real news flow.
Yeah, so Omnia's, obviously the change in dynamics for a lot of the issues that we talked about, particularly Ukraine and product coming out of there. The pricing has been quite beneficial to them. So, the product prices have gone up. Farmers are doing pretty well because the maize price is high. So, it's a combination of they've had higher prices, been able to pass it on, and their customers in very good shape from a kind of farmer and maize price perspective. So that's all conspired to give them quite positive earnings. In that space, we actually prefer AECR to Omnia. Omnia's got more of a headline presence. People are more familiar with it. AECR is a lot more liquid, but they've got a lot of the same drivers, and AECR has lagged it completely. So if you're in Omnia and you made quite a bit of money out of it, we would, and in fact, have been switching from that into AECR.
Currently, does it mean your forward earning forecasts are potentially more inaccurate under normal market circumstances?
Yeah, I think there's less certainty about forward earnings. I think we have seen quite a few of them kind of trimmed down. I think if you look, I think this year, you're kind of sitting in May, you get a pretty good feel for what 2022 looks like. Still very strong consumer growth coming through. This isn't really a South African issue. I think nobody's forecasting massive growth numbers for South African businesses. We're really talking about US markets. where there's a fair bit of earnings risk, and that the earnings growth. But as I said, there is some natural kind of backup recovery earnings growth still in 2023, because a lot of the companies are coming through saying they simply don't have the products to meet demand. So the earnings growth in the US of 17% this year and 10% next year, that could land up being 14% and 6% in a pretty negative outcome. But and that's why you kind of want that forward PE multiple, in order to bang the table and go, guys, no matter what happens, like this is a great level to buy the market. You'd probably want it to be about 10% lower. But again, to repeat myself, at that, if you go from market down to share levels, a company like Walt Disney is the cheapest it's been in cheapest 6 years ago. So its earnings outlook looks great.
Pete, your 12-month view on the rand.
So we're still in the kind of 14.50, probably 15 rand. That's kind of our official view as we sit. I think it's the biggest influence by country mile is commodity prices. SA and the rand has been a commodity story. We currently still think that the commodity story is a good one. Prices are very high. Some of them have come off a bit. And it's the easy money's been made in the commodity side. It's a case of to what extent prices stay high for a reasonable time period. China has been the threat to that. So you've seen iron ore come off from 170 to 130. But China, once it's gone through its COVID reaction that it's been through now, it's that they have a long history of stimulating from an infrastructure perspective quite soon. So we think there's quite a lot of reason for commodity prices to hold up. Once the commodity cycle goes down, and it is a cycle, we think you can see a big weakening of the rand thereafter. But we still think from a 12-month perspective that it looks pretty reasonable.
Pete, do you have any view on prescribed assets in South Africa and its potential impacts? I assume that's in the pension fund space.
Yeah, so there's lots of different ways it can go. The one big move we've had in the pension fund space or the CIA space is you can now go to 45% global equities compared to 30. That's been allowed for a while now. I don't think there is a massive impact on pricing. I think things tend to price at the right level based on their prospects and supply demand. And going from 30 to 45 doesn't mean 50% more money goes out. You'll average out at 35 or 36. And once you give people some freedom, they don't shift everything if they don't think you're going to bring it back. You've then got in the pension fund space, do they force you to put more money into infrastructure or into Eskom or to Eskom bonds? I think, there's certainly a risk of that. The current fiscus and government has been quite good at kind of staying away, despite lots of noise and position papers and the like. They've been quite market friendly from a understanding that doing things that are quite restrictive, are very negative for markets and for sentiment. I think the government's, if you look at the record, has actually been pretty good at we haven't had the prescribed asset scares that we were concerned about. But it remains a risk, that's one of the kind of endemic SA longer term risks if you've got assets that are in that prescribed category.
Pete, are you of the opinion that it is risk on now, or are we heading into a bear market with some downside, with more downside in the market? Do you prefer local or offshore? Are EM still a great buy?
Sure. No, we risk off at the moment. I think that's the core. That's the theme of the presentation, is to say that greed's disappeared completely and everybody's just concerned about the downside. I think that can take its time to work its way out of the market a bit. I think we've given some perspectives on where that can go from a valuation point of view. But the market action, the volatility, and is certainly indicative of risk off. And it's people just aren't certain how far this inflation and interest rate thing can go. But I think we've explained our principle in terms of what you would get into the market now and what you wouldn't. and getting into the market now, one's got to have a very clear ability to stomach some further volatility. From an SA versus offshore perspective, I think we've been banging the drum on SA versus offshore for the last 9-12 months. SA has dramatically outperformed offshore, but I think the pendulum has swung quite a bit. The relative value you can get on good growth global shares is much more attractive than obviously it was 6 months ago. So we'd be starting to shift more into offshore from local at this point.
Pete, do you regard lithium as overpriced, but the deficit is expected to widen massively over the next decade?
Yeah, so lithium probably is overpriced. Lithium is, the way I understand it, I'm not an expert on it, we're not invested in it, but it's not a scarce asset at all. So the guys aren't too worried about the pricing of it from the stuff I've read, because you can get a supply response in a reasonably quick time. But lithium has certainly gone up way in excess of expectations. But I think it will be like any other commodity where you have squeezes, and then it's the ability of suppliers of the product to meet the increasing demand. And there's certainly a massive amount of new exploration and development going into lithium, which, so for example, Sibanye were invested in, they started investing in some lithium businesses, and they've gone, it's way off the chart now. They'll wait a year for prices to kind of come down and settle.
The last question for today. Do you believe rotation into value could see value outperform over the next several years, or are you expecting a bounce back in growth in the shorter term? I'm assuming it's both local and offshore they're talking.
Yeah, so you've seen a rotation from growth into value. That's been the big theme over the course of the last year. There's a point at which that reverses. And what we've been trying to show in this presentation is a lot of the value more defensive shares are now actually pretty damn expensive. So the value, ironically, is starting to come back to being in the growth shares rather than the value shares. What we like about growth shares over time, if you've got a company that's got a cheap value, but not much growth, once you've had a sharp increase in the share price, then it gets closer to its value, and it's difficult to grow thereafter. A growth company, if you can find a company growing at 15, 20%, just the inflection of time makes it 15 or 20% cheaper every year. You've kind of just got a hell of a lot more momentum in it, and you can be more comfortable and confident in holding it over a time period.
Pete, maybe one more quick one. Have we seen the death of crypto and some of these other cryptocurrencies in this last crash?
Yeah, so we've never been great crypto components. We very much valuation people. The inherent value of these things is mostly zero. And as we've been saying to people for quite some time, if the price went up or down 50% over a 6-month period, we couldn't explain either. It hasn't landed up being a hedge and kind of the equivalent to gold, as people said it would be. And the recent, for those of you not aware, recently you've had some crashes, and people who perceived assets to be fixed against the dollar have gone well down below. So I think confidence levels have been dented somewhat, but it's not a space we get hell of excited to play.
Thank you very, very much, Peter. As always, thank you for your time, and thank you for all of you for attending. It's wonderful to see everybody stayed throughout, and we look forward to seeing you at the next Essentials next month. Thanks very much, and goodbye.